Good afternoon and welcome to the webinar. My name is Greg Taylor and I work for Validus, the market-leading financial data sharing company. And I have a veritable feast for you today in terms of fintech minds. And we will be sharing our views on 2018 and looking forward to 2019. I'm excited to say that Ryan Weeks, editor of AltFi, has joined us to moderate this session today. And so I'm going to hand it straight over to Ryan. Right.
Thanks, Greg. Just a quick word about AltFi. So we're a fintech trade publication, all online, and we cover, as the name suggests, alternative finance, so peer-to-peer lending, online lending, crowdfunding. We also do digital banking, and we also do sort of digital wealth management, and we run events. So I'm going to start by introducing my fellow panelists, and we'll start with the other Ryan on session, who is the MD of Funding Options. Ryan.
Hi, I'm the Managing Director for Funding Options. So we're the UK's largest online marketplace for business finance. So 2018, we've managed to help well over 2,000 small business owners get access to over £100 million. And how we do that? Nice and easy marketplace of alternative finance lenders that offer working capital, asset finance, property finance solutions, ranging from £1,000 up to 100 million. We've got hybrid models, so we utilise some technology in areas such as open banking and APIs to offer up automated decision-making for our customers. And in other areas, we've actually got a customer care team that will actually help the customer through some of the more laborious processes as well. That's it.
Great. Nicholas from Fractal Labs, over to you.
Thank you. Yeah, so Nick Heller, CEO, co-founder of Fractal Labs. We are a financial intelligence and insights platform that powers business banking. So we have an API-based platform, and we partner with leading banking institutions across the UK and Europe and the world to help them better service their customers. So we are at the forefront of the open banking revolution in that we are an authorized payment institution. We pick up various permission-based data sources from business banking customers, and we really help them better understand their finance and help the banks originate lending opportunities or other financial services opportunities.
Great, thank you. Greg, do you want to reintroduce yourself, or is that?
Yeah, no, that's fine. We share and standardize accounting data for SMEs so they can get access to loans or things like that quicker. We are based in London and have been operating for the last 3 years or so, working with the big banks and the big accounting firms to plug in our APIs.
Great. And last but of course not least, Roger, whose offices we're sitting in. Would you like to introduce yourself and Trade Ledger?
No problem. So Roger Vincent, I run the UK operations of Trade Ledger. Trade Ledger was started 2.5 years ago in Sydney, Australia, and has since then been delivering our cloud software to banks and alternative finance providers in the corporate lending space. So the cloud-based API platform that we deliver digitizes all sorts of corporate lending products such as invoice finance, supply chain finance, and trade finance, all the way down to unsecured SME finance. And we plan to convert what is typically an hours or days process into a 4-minute digital application journey, leveraging all sorts of things like open banking and wider open data such as ERP, accounting packages, etc.
Great. So to borrow Greg's phrase, a veritable feast of fintech expertise. We're going to get started by talking about the theme of digital transformation. And if I could just say a few words to sort of introduce the topic. I mean, one of the things that we've been most interested in the past year at AltFi in this particular niche has been flanker brands, which we've seen a great many of emerge in the past sort of 12 months. Particularly active has been NatWest with its SME lending platform, which is committed to scaling. It now has a new business-only bank account called Metal. And of course, there's also the rumoured consumer offering, which I think is called Bow. A lot going on there. HSBC have a lot of plans in the open banking space. We run an event in Amsterdam every year where ABN AMRO have an online lender called New 10. There really is quite a lot going on. But I'm going to throw it open to everybody. What do we make of flanker brands or standalone platforms, whatever they're going to be called. Are they here to stay, or are they a bit of a stopgap as banks try to better equip themselves to service customers online?
Yeah, I guess if I take that one. This is just my perspective in terms of working with a few of them. I think what we've seen over the last 4 or 5 years in terms of digital transformation has been somewhat slow, especially if you look at the CMA9. I think there's been an eye-opening movement in the market when you look at more so on the consumer side, which is always a couple of years ahead. So looking specifically at the likes of Monzo, Starling, Revolut, who actually came in to show that there is actually a different business model out there. And this was the start of the unbundling of the banks and actually rebundling of third-party services and actually finding a more cost-effective way and cost-effective model to service customers that previously they just weren't interested in. And I think from a lending perspective as well, when you start looking at the cost of service and the cost of capital, when you talk about loans, say, sub 250, it's just not an efficient way for them to go about it. So the flanker brand movement has been an interesting one from them to actually find a go-to-market strategy, a cost-effective way to actually start from fresh, because they've really struggled in terms of actually legacy infrastructure to actually get these solutions out quickly enough. And to test. I think for me, a lot of the focus in terms of this is also about trying something new without actually damaging the trust in the core brand itself. And that might sound like an odd thing, because every single report you see, every which report will tell you there is no trust, or there's very little, unfortunately, with the banks themselves. But they do need to hold on to as much as possible. So there is a huge amount of inertia internally, and for them to cast aside, say, 25 million, 50 million, for at times what sounds like pet projects because there are so many of them springing up, it's a safer way to go and challenge and test the market. So for me, it's that go-to-market strategy and a way to price effectively come up with new solutions for their customers. And yeah, it's a really positive time in the market.
Just before we move on to other comments, 2 questions for you, Ryan. So yeah, would you have, say, an SME as a lender in your marketplace? Because you mentioned you work mostly with alternative lenders.
Yeah,
you would have them.
100%. So I think the challenge that the likes of SME have got, they're not completely followed from RBS.
Yeah.
And at times I can appreciate that might make it difficult in terms of being as nimble as a standalone lender that can make obviously their own decisions in terms of credit policies.
Yeah.
But from our perspective, we do a lot of work with SME, and we see them as a great alternative finance lender. They've brought on board some fantastic people from within the bank, and then equally a lot of people from alternative finance lenders, and they're trying to get the right blend and mix. And we're seeing them actually slowly evolve their lending model, and we're seeing definitely increases over 2018 from what we're doing individually as a marketplace with them.
I think just picking up on that point and kind of tackling it from not a brand perspective. I think tackling it from a technology perspective purely. I mean, we're a technology provider to banks, and we talk about this all the time around how you properly go about technology, digitization, and more specifically lending digitization. And banks tend to have rushed ahead with a branding exercise and rushed ahead with creating innovation labs, rushed ahead with partnering with lender turn platforms. I think we saw a lot with EasyBob and SME, Market Invoice and Barclays. We've seen that investment. We've seen
JP Morgan and On Deck.
JP Morgan and On Deck, yeah, but JP Morgan is also a very good example of doing it well with markets and developing it themselves. I think what has been Goldman, actually. Goldman. Goldman Sachs. I think what we've learned is when you do partner with these lender turn platforms, there is only so far that you can go. None of them have escaped the unsecured lending space. None of them have penetrated the mid-market. All of them are aiming at quite a busy space, the SME unsecured lending space. And I think when they look to apply what they've learned in the kind of early stage strategies, they might come a cropper in terms of how they deploy that technology, not just locally for other products, but also globally for global trade banks that we speak to. You really do need to take a true platform approach and make sure that that platform is supportive of multiple products. It can scale and take consideration of having a supply chain relationship, because what we're talking about here in unsecured world is just an end client, an applicant, maybe a joint applicant. doesn't consider debtors, doesn't consider suppliers, doesn't consider how they interact with each other and how a bank manages that.
Yeah.
And that's the type of things that platforms, specialist platforms that only focus in the corporate lending space have tackled. And I think that's where we're starting to see significant traction in the market from banks taking phase 2 of digitization and really starting to push forward the platform approach.
One thing to add on to that though, so I fully agree with everything that Roger's saying, and what I'd probably build onto that is you've got to start small. So if you actually look in terms of the complexity, there's, I mean, for us alone, there's 24 different types of products. So if you start then kind of consolidating that into down, what you have is really working capital, you know, you've got asset finance and property finance. Now, if you look from an intermediated perspective, in the UK alone, per annum, £15 billion is intermediated. Now, 1.9 billion of that is actually working capital. Working capital is the smallest part. 5.5 billion is actually asset finance, and the rest is property finance. So everybody's hammered into this one space, and the problem, I guess, there is that a lot of the problem is that it's the opportunity because it's relatively simple, and actually it's not as complex. And when you actually look in terms of the ticket sizes, typically we're talking sub 20k, sub 50k, and there's a huge demand there for that type of solution. But what we now need to see is evolution in terms of bringing in alternative data sources and actually getting the complete view in terms of that supply chain to understand where the actual discrepancies are and where the opportunities are. Asset finance for me is the next big place that we're looking at. I think for me, it's also looking at the lenders themselves in terms of the antiquated ways that they go about the underwriting process. You know, we recently helped a customer, Northern Ireland construction business, purchase a JCB, right? But the underwriter wants to go over there, kick the tires at the JCB, you know, wants to actually look at the customer, you know, the white of the eyes and go through their own due diligence process. It's a lot more labour intensive. So it's understanding where can you bring technology into this, into different areas. And the transformation won't be overnight, but it'll be slow cuts, death by 1,000 cuts, I imagine.
Yes. Well, it's interesting, particularly in the secured lending space, you wonder if you ever escape the need to kick the tires, at least to some degree, at least nudge them with the toe. But yeah, anyway, any thoughts from Greg or Nick?
Well, I'll just mention, I'll just pick up on what Ryan said. So I think actually this comes down to the state of their technology stack and their ability to actually execute using their core banking stack. The reality is we worked with one of the major leading incumbent banks here in the UK a few years ago, and we mapped out their process that they take from initial contact in through getting money into the bank to one of their SME customers. And it was a 14-step process that took plus 100 days, right? And that was operationally very expensive, from the people involved to the processes that they used and the data and how they actually analyze that information. So I think what the banks are doing is, one, experimenting with a new brand, but also just realizing that whatever they can build outside of their core banking infrastructure on their own will be a lot faster and sleeker and simpler and easier for them to actually test, iterate, and learn from. And I think Steve Jobs said it best during his time, is that either cannibalize yourself or be cannibalized. So they may as well do this experimentation, come out with a new brand, with a new platform, and actually try and compete with the neobanks and the alternative lenders in the market.
Yeah, thanks, Nick. I'd say the original question, we don't know. We don't know if they'll still be around. Certainly what we've been seeing is that the advances in the technology stack, it echoes Nick's point really, that we're taking decisioning down from weeks and days in places to hours and minutes instead. And I don't think that's a position that the banks can go back from. So whether it's a fintech or whether it's something built by the bank, we're in a position now where that has moved the level of technology forwards and the ability forwards, and therefore you can't then retrace that.
I guess just before we move on, because probably should move on to the next topic, but is there any sort of ethical consideration about flanker brands? I know everyone calls them that, but that's what I've become used to calling them. Is there, a lot of them, like a Yolt, for example, which is powered by ING, it's very difficult to find ING actually on the website. It's the same with SME and a number of others. Does anyone have any thoughts on this? Is it wrong to sort of obscure the relationship with the parent bank?
Well, I think what we don't know is whether any of these initiatives are at all profitable, or if they ever intend to be profitable, or if they're actually just going to eat up part of the market that the alternative or the new entrants are trying to play in. And so I think that time will tell, but I think my understanding is that most of those, the business model still doesn't stack up, because what you save, I guess, in infrastructure and process costs and using new methods, you end up spending in cost per acquisition, and then you end up trying to acquire a bunch of new customers. Now, considering banks still have 45% of their cost structure based around distribution, they have a natural way of actually disseminating their message and acquiring new customers. But I think that there is the thought that it could be potentially anti-competitive when they're just launching new brands that confuses the end customer, because at the end of the day, the end customer has no idea whether this is a big bank or not. They see it as a new brand, they might see the new branding, they might like that. So I'm not sure it increases competition in the market, that's for sure.
I think it almost depends on what type of customer you're aiming at. So we've seen, as Ryan said, we've seen the consumer space leap ahead and a huge influx of customers moving over to challenger brands. Whether they lose their existing bank or whether they don't, they're all enticed by some sort of flashy card, some sort of incentive. It's kind of that, if you don't bank with Monzo in Shoreditch, then you're not cool. Exactly. And if you don't have a Revolut Metal card, then you can't join the club. I think where we're considering corporate banking and probably the larger scale SMEs in that space, they don't really care. They don't care about brands. They don't care who they bank with. They care that they get working capital, specifically to lending. And that's all they've ever cared about. So when you position 20, how much do you get for what price? And does it help me pay my staff at the end of the month? It's not about a flashy card. It's not about a perk or a gimmick. It's a very different customer base that we're looking at here. So how the kind of branch brands or the flanker brands, as we call it, will impact the commercial space, I think will be in a very different way.
Yeah, and just to echo what Roger's saying there, we find ourselves, the emotive side of running a small business is far different than being over in Shoreditch with your hot coral card out there in whatever bar it might be. We look through, our customers come in and, we see fluctuations day in, day out over the weeks, and we'll see our small business owners coming in, late at night on a Sunday, late on a Tuesday evening, and as Roger's saying, it's a Sequoia capital, a well-known VC would call it. It's all about those hair and fire moments, and that's what real product market fit's about. And when we go into user research, it's about, can I make payroll Friday? I've just been let down by one of my customers. I've got an invoice, I've got a VAT bill, whatever else it might be. It's a job to be done, and they just need to get it done as quickly and as efficiently as possible. And it's about whoever is there that's going to help them achieve that smoothly. And the bank itself needs to be in a position to do that. Whatever technology is in place, so be it. But I think what we are now starting to see is that movement towards more microservices architecture, and a different work and a different type of infrastructure altogether is helping them achieve that and getting away from the monolithic back end that they all have.
Okay. Great. Well, I think we did a really good job there on digital transformation. We're going to come on to the equally large topic of data sharing. I guess I'll kick us off by saying that obviously this was year one of Open Banking PSD2, very nearly at its end. And I think what we've seen so far really in terms of products fall into three categories. So we've had things that make lending decisions or other decisions or onboarding of some kind more efficient. We've had things that help consumers or businesses, customers, let's say, compare products more easily, launch. And then we've also had some sort of consolidation services, which kind of already existed, but again, I think probably work more efficiently with Open Banking Live. What do we think we will see perhaps next year or further into the future that we haven't so far? So I think a lot of people think that Open Banking after year one is really still very much in its infancy, and I'll just put that out to everybody.
I think coming back from a conference last week up in Edinburgh, an F-Data conference, the biggest thing that I took coming out of that was that Open Banking are moving forward to allowing commercial APIs be pushed into the Open Banking ecosystem. So leveraging the same authentication that banks will use, AISPs, PISPs, banks can now push their monetized APIs into that ecosystem. I think that's going to be, some argue we should have gone that way in the first place. Some argue that it would have resulted in better quality APIs. And a number of the fintechs will jump on board with the banks to say that.
So what does that mean then if a bank is pushing its monetized API? How is that different to what's currently happening?
So there's obviously regulatory requirements of kind of being a PSD2 compliant bank, or being an open banking compliant bank. 9 of them, from the UK and other voluntary banks, 3,000 across Europe. That data tends to look at account information, your transaction data, your sort code, bank account number. Very, very powerful in certain circumstances, but by no means the full suite of data that a bank could offer up for sharing. So, for example, if a bank wanted to share their credit score, they could now do that through the open banking system. So if someone was plugged into that third-party fintech, they could take the credit score from the bank as opposed to a credit bureau.
I see.
A very interesting concept when you think about the ecosystem of players in the current financial services space.
Very interesting.
Yeah, we see. So I would agree that open banking is in its absolute infancy, and there's been some teething issues. I mean, just getting standardization around the APIs has been a challenge, and we've integrated directly with the top 14 commercial banks in the UK, and that's been that is an ongoing challenge because they have their own issues on their side just to be able to retrieve the data. And so I think what we're going to see next year is some sort of stabilization in the APIs, which then will give more ability and comfort for those TTPs that are using the data to do more efficient and effective solutions out there to service SMEs. And I'll just mention one other thing. So that's on the AISP side. On the PISP side, we're talking in the absolute infancy because there's actually only one thing you can do, which is every single time you want to initiate a payment, you have to, the end business or customer has to re-authenticate. So we're not even in a place where we can start planning payments. But that said, I think next year, even more regulatory changes are going to increase and accelerate the ability for third parties to be able to pick up data, things like making tax digital, increases the likelihood that businesses will put their data online, which gives businesses like ourselves the ability to get it. So I think it's still early days, but I think it's promising, and I think we're only starting to see the innovation that's going to happen in the new year.
Just quickly, just saying one second, that you sit between third parties and banks effectively in the open bank in data sharing process, and to some extent you're standardizing that process. Is that correct to say? And my second question, if that is correct, is there's a few businesses now doing that. You've got, or something like that. You've got TrueLayer, Account Score has something. You guys, I'm sure there are others. Do you think we'll see more? Do you think those businesses have? Obviously you do think they have a big opportunity, but do you think we'll see a proliferation of those businesses in the ecosystem?
Yeah, I don't think we're exactly like the businesses that you mentioned. We did account, data aggregation and our own integrations based on the necessity that no one else is doing in the market. But we also enhance data and create an intelligence layer. So we focus on customer engagement because we believe an engaged customer who understands their finances and can be then alerted of when things are going right or going wrong will be a huge driver towards getting funding to those businesses at the right time. So I actually think there aren't going to be a ton of data aggregators like the TrueLayers of the world, because it's a very hard problem, and there are 3,000 plus banks in Europe, if not more. So to do all those integrations and to maintain all those integrations is a business within itself. And we saw the Yodleys of yesteryear were the ones that emerged as a key player there, and I think there will be a handful of key players around Europe in this space.
Okay, great. Ryan, you had a point.
I was going to actually echo what Nick was talking about there. So I think from our perspective, standardization in terms of the APIs is obviously one thing. Speed, responsiveness, it might sound really basic, but we've seen variations go from 3 seconds up to 22 seconds. I've seen some interesting studies and announcements from Google where they talk about the drop-off rates, being 20% for 1 second delay. So that's going to have a massive impact in terms of customers actually completing the journey. There's actually just the user journey itself, like the number of clicks. It might sound really basic, but in terms of the actual design, the actual copy, right now the biggest issue that we see is more around trust and user adoption. So we see lots of figures going out there in terms of increases in terms of the number of API calls. I think over the summer we saw it literally jump from 2 million to 3 million over June to July from memory. So we know that it's on the rise, which is fantastic, but we are talking about the early adopters. So how is this going to hit the mainstream? I do say this, but on the counter that, we did just fund our first ever customer with the use of open banking, and that was a small beauty salon down in deep dark parts of Kent. Right. So it's not exactly what you'd expect as kind of an early adopter, but in the end, you can't really shoot people that way.
I think controversially, I think we need to stop really talking about open banking. I think open banking is whether it's a failure or success, what it did in terms of the global scene has been absolutely huge. You now have 28 different countries across the world looking at the UK as not necessarily a country that did it right, but a country that was brave enough to go ahead and do it. Yeah. And obviously, being a first mover is not going to be an advantage in this space. There's too many elements to get right, too many things to iron out. But what it does is act as the catalyst for a wider program of open data. So we talk about Validus providing accountancy data. That's been in the market for years. You look at Plaid, who raised £250 million and are now valued at 2.6 billion. They've been doing that for years. So has Yodlee. These guys are already established around the world. The question is, how do we come together in a global economy to standardize this data? So as a business working between Australia and the UK currently, we're in talks with the governments on both sides and the likes of S-Data about how we standardize data flows between the two regions. And that can do absolutely huge things in the supply chain world, where the flow of data between businesses trading across Australia and the UK can actually increase the trade productivity of businesses in the UK, in Australia, and actually into the Asian markets, where I think that we all agree the big opportunity is.
Yeah, we at AltFi just got back from Toronto last week where we were running an event pretty much wholly focused on, sorry to use the term, open banking and bringing UK leaders in the field over, to talk to an audience of Canadian fintech owners and founders and whatever else. And so really, really good engagement from the audience there. And, the government is looking at implementing a framework exactly in the model of the UK, as you say. So, it's very interesting. And Greg, I think you were going to chime in.
Yeah, it was just a survey from Which that I saw that, still saying that only 1 in 10 consumers even know what open banking is, right? So I think we talk about it a lot, and we work, first mover, first adopter, all that sort of stuff. It's either been purposefully downplayed to the consumer, or it's not been translated well enough in terms of what is being done. And maybe that's a good thing, right? Maybe that means we can continue to develop the architecture, continue to develop the standards in order to get to a better place when adoption, in a few years' time, is a much more present thing, right? Because that then leads into trust, as Ryan was saying, the value exchange. What are they going to get back for that as a consumer? But we're not there yet, right? And actually, that's probably a good thing that no one knows what it is.
It's incredible. So what I actually found quite amusing was looking back in January this year. It did feel like, strange enough, because we were in December and it's obviously Christmas time, but I genuinely felt that kind of Christmas Eve excitement of kind of waking up and being like, oh my God, what's going to happen tomorrow when it finally went live. And then there's this kind of, it was really downbeat in terms of the whole industry, like straight afterwards, which really surprised me. And I think everybody's, I think there's a famous saying which kind of says, everybody overestimates the impact of technology in terms of the short term and underestimates it in terms of the long term. And this for me is the equivalent to creating an app store. Like, there are so many different solutions that are out there. But what Greg's saying there is absolutely spot on. It's about the value proposition. There isn't the benefit of standing on the shoulder of giants, as Roger says, that we can go, we're like this little piece that Sweden did over here, or we love what Australia did over here, but we're not too sure about that, what Germany are doing. So let's go down this route. So we're having to be the guinea pig for the rest of the world to look at right now. And sure, we're gonna go down some paths that perhaps won't be the right ones.
It's a really interesting point, yeah. So the UK's sort of fintech leadership places it in a slightly precarious position as well, which is an interesting angle.
I don't think it's bad though. So we participated in fintech missions to Mexico, Australia. We have someone in India right now, and in Mexico and Australia being examples of where open banking is actually being legislated and is going live. I think they are looking to the UK as examples, and I think there is something of a first mover advantage in that we will have tested and learned, and sure they can watch where there's been a failure and where there's been a success. But I think actually having that experience can be a huge advantage for the country and for those participating.
For fintech startups as well, in terms of actually evolving your solution and actually getting to market quickly and actually understanding what works and doesn't, 100% behind you there. You know, again, it does give us an ability to go out there and export our goods and services.
And I'll just say one last thing. The fact that we call it open banking or PSD2 or whatever, like who cares? And the customer certainly doesn't care.
Yep.
You just need to tell them that you can get your data out of your bank quickly for the purposes of, I don't know, maybe getting finance or maybe actually getting some value back. That's fantastic. And I think we've seen no one resist that. We haven't seen anyone say, well, wait a second, because they still have to get their data out of their bank at some point anyway. So the fact is you may make it easy, people are all for that.
And that notion that, you know what, the bank doesn't own my data, I own my fucking data, right? And that's a real clear move. And that's what I love about open banking and PSD2.
Great. Okay. One thing I'd add is that I think you'll struggle to get journalists to stop using the term open banking, given all the SEO benefits that are there. But there we go. Moving on to confidence in the UK market, a slight change in the agenda. What can I say to tee that up? I guess obviously, you know, the terrible Brexit term is what we'll be focusing on. For me, the thing that I've noticed most in relation to Brexit and fintech is that there has been a bit of a squeeze in engineering talent, and then a lot of fintechs are finding that market more competitive. They're having to pay engineers more, and actually some are setting up sort of, I see a few eyes wide, and actually some are sort of setting up hubs overseas, whether it be in sort of, I think Tallinn's quite a popular place for that, etc. To then continue to attract the best talent from Europe and around the world whenever we do actually leave the European Union. Around the table, is anybody finding this? Is anybody having issues hiring engineers?
Talent's just a kind of a topic all in its own right, I suppose. It's depends what scale of business you are, and how mature your talent strategy is. At the smaller end of fintech, I think you go through that stage where even entertaining the idea of supporting visas is probably a little bit out there. When you get to a certain scale, you can start to do that. So that will come into your remit.
How big do you have to be, roughly, you know, by headcount?
Who knows? Who knows? I think it's about having the right people in the right place. Right. So we were talking before this about having a head of talent, a head of someone that's driving your talent strategy. I think for most fintechs, when they approach a talent or a recruiter, being pushed with recruiter fees is not something that we can stomach. So the recruitment agencies are also catching up. They're launching fintechs that allow us to recruit in different ways and hack talent, which is great. But it depends what you leverage, how much opportunity you've got to leverage that. But this issue of talent isn't about Brexit. It's hereditary in our educational systems that we're not necessarily teaching the right things to support the future economy.
Brexit doesn't make it harder even. I reckon Brexit's a problem generally.
But as I said, back to are you the right scale to consider whether Brexit has the impact on you or not? And I think a lot of fintechs are not at that scale yet.
So in terms of what Roger's saying there, definitely there's obviously a grassroots problem in terms of the UK when it comes to stem cells. Everybody knows that, right? I think we're all aware. And there has definitely been a open for business narrative for fintech over the last decade, which has really helped propel our position up there as one of the best ecosystems in the world. This is my perspective. We definitely struggled over the last 18 months, 24 months, in terms of building out our engineering team. We're a Python Django house. Predominantly all of our.
Sounds like a club.
Yes. I think we're going there later.
Yeah.
That's awesome. yes, we're a Python Django house, and it's tricky. And I think we are, with engineering teams now 10, we haven't quite, especially if I look back 18 months ago, we didn't necessarily have that escape velocity. So for a lot of fintechs, when you get to a certain size in terms of your engineering team, you can start actually bringing on more junior level talent. So you can start hoovering up, grads and actually train them up. You can do a bit of pair programming. You might even do a bit of mobbing every now and again, depends on how your structure is. But actually, you need to get to that size. And really, for me, the inflection point is 10, so that you can then start bringing them through at that level, at that grad level. But for us, our team is hugely diverse. I think over 60% of our workforce is international. So we're really heavily dependent on actually pulling in talent from Europe. So I think the talent point is one thing. I think the other thing as well is what is the narrative that then builds in terms of potential investors for fintechs and looking into Europe, because it's all of the known unknowns, right? Nobody knows really, even Theresa May, if she's still here this side tonight, I don't know. But nobody knows how this is going to play out. And it's definitely made investors second guess opportunities in the UK as opposed to mainland Europe, and what your strategy is to then get into Europe in case. But that's made it a lot more difficult, I'd say, for businesses trying to raise funds.
Would it never happen the other way around then? So, investors are not second guessing businesses in mainland Europe, but they are in the UK. But then again, access to the UK's sort of capital markets, for example, is an important thing. There are other aspects to the UK market that are desirable for UK fintechs, but you don't think that investors would be put off post-Brexit investing in a mainland European business?
I don't think so. I don't think they're mutually exclusive. Yeah, I'm not going to say that. I still think the UK is a really attractive, economy to actually get into, and I think we'll always be seen that way. I think for a lot of mainland Europeans, the natural route to get to North America is always seen as, right, have you launched into the UK? Are you now going to go over to North America? And that's just the stepping stone that people take. So, and I don't think that's going to go overnight. I think we've got a deeply entrenched position within financial services, and that's not going to disappear overnight. And there's some fantastic businesses in the UK. So I still see it as a thriving marketplace. We've got 5.5 million small businesses, 70 million consumers out there. We're a big market in its own right. But again, if you then compare that to mainland Europe, where it's 450 million people and it's 23 million SMEs, that's a big chunk as well.
Yeah.
So I'm not saying mutually exclusive. Yeah. I don't think I think it works against us, not for us.
Okay. And what can we say about customers then? It's relevant to everyone here, I think, the willingness of businesses in particular and consumers to borrow at the moment. Has that been negatively affected by the whole Brexit process or other factors?
I think just looking at the state of the SME lending space, if we're talking about lending in general, there's a huge issue with how businesses are sourcing their capital, but that's been going on for the last 10 years, regardless of Brexit. And I think businesses, if they need the cash, will turn to places that provide it quickly, not necessarily at the right price. For the reasons of working capital, they might probably go ahead, but for investment and kind of growth, they might be second guessing themselves. But most small businesses in the UK, because the banks have been removing this kind of overdraft facility, have been turning to unsecured forms of credit cards, for example. And that's no different globally. I think the issue maybe is what type of working capital or growth capital are these businesses looking to access? Is it right for them? Is it secured? Is it unsecured? And at what time in their business can they get that? And I think it's up to us as an industry to do better at communicating that to them, providing working capital insights, combining the features of open banking that open banking is supposed to bring, combining to provide a better functioning lending environment for small businesses to search for capital. Nothing to do, in my opinion, with Brexit and confidence.
I think it depends on obviously the type of business, right? If you're doing a lot of international trade, then it could be really adversely affect you if there is issues with Europe. And so you could say trade finance potentially gets impacted there. I don't know if we've seen anything happen yet. But also, I would just say, I think to Roger's point is that most SMEs are thinking about the next month, the next quarter, I think not many of them are thinking about the next years and how to get their working capital right and their cash right. And so the result is I'm not sure that it's really dawned on them, nor does anyone really understand what it's going to mean. I'm just say one last thing from our perspective. There is an issue around financial services, obviously with passporting, and we've taken our own measures to look into other European markets to actually get licensed in those markets so that we can then passport across Europe in case something happens with passporting. Our ability as an authorized payment institution from the UK.
Okay. And just so before we come to you guys, so we mentioned you mentioned then banks possibly retrenching, when it comes to sort of trade finance solutions. I hear a lot from alternative lenders that Brexit and other kinds of disruption often present opportunities because banks are more cautious than they are, or rather they have a more flexible way of looking at the suitability of customers. You might have some data on this, right? Are you seeing alternative lenders sort of coming to the fore at this time?
Yeah, absolutely. I was going to say, because there's a couple of things just to tackle on both on that point in terms of filling the gap, which Roger mentioned in terms of the overdraft closures, which I think something like £5 million a day. So it's a huge amount. What we have seen is a number of different players and products start to emerge in the space, and some of them quite innovative. So things like merchant cash balance products, very innovative in terms of their approach to actually get that at the point of sale and then actually skim off, a repayment every time sales actually done. And it deals really well with the fluctuations. However, it can be really high APR. You could be talking about 30, 35%. And I think this is the point that Roger's talking about, which is really important. It's understanding that there's lots of different products that are out there, but it's almost kind of going on that whole benevolent ambivalence in terms of actually trying to educate customers in terms of what's the right type of product at the right type of time. The credit card point, which you made just before, has become almost a go-to-market strategy because it's actually really low friction in terms of customers actually going over that hurdle in terms of, hold on, £10,000 loan, £50,000 loan, £100,000, I've got a credit card there, I'll just start using. So what what you start seeing is basically, from a product perspective, people going in with business credit card solutions, and then they start to see adoption then kick off, and then they're then flipping them over to a different product altogether. My worrying concern in terms of the lending marketplace right now is more around digital inclusion. And I think there are some really innovative lenders out there that are utilizing alternative data sources to better credit profile customers and to offer them access to finance very quickly and seamlessly within minutes. Okay? Are they the cheapest product for them is the question, and are they getting hooked on credit is my worry. Now, if you look in terms of the alternative finance landscape, it's a mixed ability in terms of technical capabilities. So do I believe that they're going to get the rate of adoption and be able to go compete with those more digitally innovative lenders all in the next year or two? I'm not too sure. So again, my worry is more about the customers and is about pricing. And then for our role as a marketplace is how do we tackle that digital inclusiveness? So that's going to be looking at our API strategy into 2019.
Yeah, it's interesting. Financial inclusion is often sort of pitched as a sort of very benevolent idea, which I'm sure in many ways it is. And, there's really interesting businesses like Neighbour, which do sort of loans as an employee benefit, so they can slightly de-risk perhaps lenders because they're taking payments, borrowers rather, taking payments directly from their salary, which, slightly de-risk the whole thing. But and they really drive that message of financial inclusion, financial well-being, etc. But then, their loans are funded by Goldman Sachs, and I suspect they require a certain return on their investment. And it's just an interesting sort of dilemma.
85% of commercial banks make, the vast majority of commercial banks make 85% of their revenue from 25% of their customer base in the SME sector, which means that there's a huge segment of untapped market there. And you could argue that's about inclusion. It's actually just education, inclusion, understanding what customers' needs, and being able to profile them in a better way so that the cost of serving them comes down.
Yeah, and the right channels. I mean, we work in a space that probably you speak to any banks that 80-90% of their leads come from brokers. Now, we've seen in the consumer space, the first place you go to get a loan is Google. And I think over the next 5 years, we're going to see this monumental shift into digital marketplaces. and this isn't a plug for funding options and Ryan, but it is a
Go on, Roger.
but it is it should be a consideration for banks around how they set themselves up to tap into these markets. And some of the early platforms that are either lenders themselves, they're tackling that, they're going direct to business, sorry. Some of the other players are plugging lending into their platform, like Zero.
Yep.
That's another origination channel. How do banks start to plug themselves in? Being open, I mean, banks have got the cheapest cost of credit, so they should be able to service their consumers in the best way, not going out to short-term or alternative finance providers who are doing a better job at finding new customers and keeping them.
Yeah.
So I think thinking 3 to 5 years ahead, when that figure flips and you start to see 80% of SME loans or mid-market loans originating through digital marketplaces called Google or funding options, banks need to be set up to plug their lending products into that marketplace. Yeah. And in our experience, if you want to do that, you need to start now. Yeah. Because it's re-platforming and platforming in a way that you can expose APIs into your digital lending marketplaces is a good 12 to 18 month transformation, not necessarily from a technology perspective, but from an organizational perspective. How does a bank even think that way?
Yes. One step just to kind of back up what Roger's saying here as well. So 90% of small business owners, their first port of call for a business loan is their bank. Yeah, and that's where the journey starts. So, and to kind of bring the conversation back to what we were talking about before in terms of the great unbundling of the banks, it's about how do they actually turn themselves into more of a data-centric hub, and they are actually tying up these different customer journeys with these different services. And obviously, in this space, we try and offer what we call an alternative yes. So whereby actually if the bank themselves isn't able to lend to the customer, or that the customer isn't yet ready for bank lending, they can seamlessly pass them over to us, and we can build our marketplace or get the API into that hub itself. Yeah. Or alternatively, they can hand them over and we can take care of the customer as well. Yeah. So it's horse for course in terms of what the approach is, and every bank we talk to wants a slightly different customer journey. Starling's a prime example right now where we're building on our API strategy, and they're really pushing us actually, because what they want to have is performance-related data back, and they want to control that customer journey, and that's fantastic, and we want to do that for them. So they're really pushing us to rethink how do we actually approach and service banks as well.
How are volumes trending with the mandatory referral scheme? Because I remember,
you had to go there, Ryan.
Yeah, I'm going there. Well, it's been a while since we visited it at AltFi. I think it was data came out. Was it 1 year after its launch? At that stage, people were pretty underwhelmed, but that was only a year in. I think what are we, 2 or 3 years down the track now?
2 years down, yeah, 2 years down. So we're definitely seeing volumes tick up. We've seen over 1,000 small business owners get access to funding through the bank referral scheme. I don't care what anybody says. That's 1,000 businesses that could have gone under. That's 1,000 businesses that might not have made payroll. That's 1,000 businesses. It's a considerable amount, right? And I go back to that Roy Rara, quote that I used before. Everybody overestimates in terms of the short term, underestimates it in terms of the long term. The bank referral scheme for me is a great stepping stone. It's a great ticking box for us when we go and see the compliance team at certain banks, and they can see that we've been mandated by the government and the Treasury to go and take part in this designated scheme, which is fantastic. What we have seen, however, is what is a hard decline and what's a soft decline. And there is a lot of conversation around that and the customer journey from actually when they do finally get that hard decline, what then happens and how long does that take? And again, I'll go back to why our strategy is more about folks getting further up the chain to create a smoother customer journey where we can deal with the immediacy in terms of when a customer is there crying out for funding, crying out for help. So in terms of numbers, volumes, we are seeing it uptick. We are seeing it improve. Is it improving as fast as I want? No, I've seen us go past the 10 million mark, which is fantastic for the scheme. I'd love us to get past 100 million. When we get past $1 billion, I think we can start talking about this looks like a success. Yes. But I think there's a different type of customer journey that we need to be looking at within the banks. I mean, interesting for me, and this is separate. I mean, just last week, we actually helped a small business owner get access to a commercial mortgage for £935,000. And this is where perception is wrong. So that customer was actually rejected by one of the big four. I'm not going to say which one, okay? then passed over to our team, a very talented business finance specialist team, and we have one person in particular specialising in the property side. Yeah. And actually, she was able just to go through the application process with the actual customer themselves and get the commercial mortgage for 935k with one of the other big four. So there is this perception that if you're getting declined by one of the big four, then you're not ready for bank lending. Actually, the problem a lot of the time is the banks themselves haven't got the actual staff there able to service those customers. So, and actually, up until this year, we didn't see any property finance come through because, you know what, within the banks themselves, they've got assumptions that that's what the scheme isn't there to do that. So we're now starting to see adoption within the banks themselves. We're still starting to see a lot. We're not seeing perhaps at the relationship management level start to come forward. So we're still dependent in terms of that hard decline. So
I think that's a much bigger issue around relationship management because the banks that we speak to, you can talk about digitization as an option. Digitization of the relationship management journey for many of these corporate products or commercial finance products is a necessity because all of the relationship managers are retiring. And that's not just a sweeping comment. It is a genuine concern of many banks that that expertise and that talent will exit the financial services industry full stop, which means they cannot coach customers through that journey anymore. So it is imperative that they start to digitize for survival of their products and for retention of those customers and for the good of the industry.
We're getting into the twilight of the session now, so we're going to sort of slightly speed up our Q&A. Coming on to the regulatory landscape, is it changing for the better? We write a lot about peer-to-peer lending. AltFi, the regulator is midway through its sort of FCA review. The FCA is midway through its review of the peer-to-peer lending sector. Lots of things came out of that. The biggest thing was that they are contemplating limiting retail investors to investing 10% of their net investable assets in via peer-to-peer platforms, which we think is slightly mad, and perhaps closing off a promising asset class that's delivered actually very consistent and sound returns to investors over the course of quite a growing track record. Closing off that asset class, then we think it's slightly mad. We think the regulators should move against platforms on a case-by-case basis rather than sort of regulating according to the lowest possible denominator. And there definitely are low denominators within the peer-to-peer sector, but I won't name any names. Anyway, so that's my rant over, and then moving on. So GDPR is another thing. Any other sort of regulatory points that anybody would like to make at this stage? We've definitely covered open banking, I think, but besides open banking.
Yeah, I don't think we saw I thought it was a lot of work for GDPR in the run-up. I think actually everyone got on board to prepare adequately in the end, and actually has been quite an eye-opening and positive experience for businesses to actually understand how they use data, what they do with data, and who it belongs to. So I think we talk about the hype being all that, the hype cycle of stuff that was definitely going crazy at this time last year, and then we went through that, and certainly we're in a better place now than we have been before. Great.
Yeah, I think there was a very amusing point midway through the year where literally it just seemed to swamp everybody's inboxes. I don't know, you almost have had it in terms of basically GDPR emails.
You can tell when the consultants will change their job titles to include GDPR. That's when you know it's important.
Yeah, in press it looks like PR people getting in touch with you saying, "Can we send you a press release?" Which is kind of mad, but yeah.
In some ways, though, it was a good way to clear out the inbox. That's the one thing I can say.
Yeah. I mean, outside of GDPR and kind of open banking, I think Nick mentioned making tax digital. Yeah. I think it's a great incentive for this industry. Yeah. And I think it's going to have big ramifications further downstream in terms of what data is available. Yeah. What big platforms that interact or utilize customer data, and it is customer data, going back to GDPR. And how that data is opened up into the market. So open banking is one step. Accounting data, they are opening up that, and GDPR will have a sweeping impact over that marketplace. But making tax digital gets you there in the first place, and it drives consumers into these cloud-based platforms, which makes data sharing more easy, more accessible. So in Australia, where we function, cloud accounting packages penetrate significantly more than in the UK. Now that can be seen as an asset for the Australian financial services space, it's not being leveraged because they're behind the curve on open banking and data sharing. Yeah. With the CDR coming, the consumer data right there, they are in a better position starting point wise for open data. So that for me is a really good starting point. You've also got commercial credit data sharing going through this year, where the 3 credit bureaus in the UK will inherit or have on their books the 6 million SMEs that they never usually see. Yeah. So credit bureaus usually see the consumer space quite well, very well. They see the limited company data and a small proportion of the non-limited data. Now they will see how businesses are repaying commercial loans, commercial credit cards, and commercial bank accounts. And I think that's, again, if they can get their hands around it, start to blend that with open banking data, start to blend that with other data sources, it's a really, really ripe environment for innovation and a further influx of fintech.
It's funny because, you talk about CCGS because we talk about things that are overestimated and underestimated. I think that's probably being underestimated because of the noise from open banking and making tax digital and other things.
I couldn't agree more. For me, I think it's a massive opportunity. One of the biggest problems I think the industry is going to be looking at, because of the ease of actual access to credit and debt right now, that there has been an influx in terms of potential stacking. Yeah, and I think this is a genuine worry for me within the industry, which is actually who's got insight in terms of what the actual aggregated viewpoint is of those small business customers and consumers at times as well, in terms of their total debt profile. And that for me is a worry. And again, that's not dynamic, is it? Yeah, stacking, so essentially taking up multiple loan products, and without actually, at times, the lenders not actually having access to the data to see it themselves in terms of what the true affordability is of that particular customer. Now, sometimes that's done absolutely innocently, and the customer's got a problem, they're just trying to get through it. Other times it can be done in a not so innocent way. So we see it on both sides. I mean, we saw one, and it was an innocent way, where we actually refinanced a customer where they stacked up to 6 different loan products. We actually managed to save them £8,000 a month, refinancing them onto one. And for me, I see it as an opportunity for all of those customers who have stacked in that kind of way, and we can actually get them out of that debt crisis. Holistic view. And I think that's a fantastic, and again, as Roger says there, with open banking, the ability to then have an aggregated view of the customer, you're in a better position to serve them.
Yeah, great. Regulation done. Partnership ecosystem. We've talked about the rebundling of the unbundling of the bank a lot. We've actually also talked about the rebundling of the bank. I'd say the rebundling companies are actually digital banks, because given their sort of open approach to banking and these in-app marketplaces they have, where they very much prioritize selling to third parties, it seems that for a while we had fintechs picking off things that the banks did and refining them and doing them very, very well. Now we have sort of fintech banks coming along, partnering with those guys, putting them in their marketplaces, having very, very smooth integrations. What do we think?
Well, I think just banking in general, I think it's important just to look at their business model and the way that they're structured, because banks, traditional banks inherently have an advantage given their cost of capital and fractional reserve banking. And so that's something that a lot of the neobanks still don't have yet as an opportunity. And banks make most of their money through lending. So if they have a lot of deposits, they can do a lot of lending. That's where they make the lion's share of their money. And most of the neobanks are not yet doing that, and hence are not profitable yet. Where banks do drive most of their profit, 65% of their profit comes from fee-based businesses, so getting fees on payments or fees on advice, and that's where most of the neobanks and the fintechs are really attacking the bank to try and take some of those profits away. So the result is the banks are trying to be more operationally efficient. They're realizing that they need to partner with third parties that can build 10 times faster at 10 times the cost. And they now have evolved their infrastructure to a point where they do have an application layer focused on microservices. And that's what we do at Fractal. We partner with banks. We're a cloud-based business. We're an API-based business. And what we do is help power that thin layer between their business banking customers and their products and services to give them more efficiency, to drive better margins for them, and also address a wider customer base. So what I'm seeing, I think, in the market is sort of twofold. One, banks are trying to be more efficient, and they're realizing that in order to do that, we talked about RMs retiring, they're also cutting costs, which means shutting down distribution, shutting down branches, which is where the RMs normally sit. So they actually need another way, a digital way, to do outreach and to touch these customers. So being operationally more efficient, but equally, they've now started to design their own thin layer application layer, which is in the cloud, which has APIs, driven by being pushed by things like open banking, which allow for more innovative, scalable partnerships like what we're doing, which all happen in the cloud. So I think the way forward, I think, is for the incumbent banks to work closely with particular fintechs, whether it's because they're going to get a marketplace, the ability to do a marketplace, or they're getting better access to data and insights, or otherwise, to really better service their customers. I think that's a trend that's changed in the last 12 to 18 months on the back of all these changes, technological changes, regulatory changes.
Great. All right, great. Do we have time for any more, or should we?
We're out of time. The last question was around outside of the UK and anything we've seen. So should we just run around the table and check out one point if you've got one? I can kick off and just say, India had the shared unified interface, for shared payments, and actually the work that they're doing isn't in the same, the same standard or format that the open banking activity is happening in, but it's a huge data sharing and infrastructure project that, that probably isn't getting enough awareness in the UK as it should, and actually the recognition that it should, shall we say, and that the rest of the world is actually doing other things. But to go back to, I think it was Roger's point at the start, which the number of people now looking at open banking is another level, right?
Just a point, looking further abroad, other than the UK. To me, as a tech provider into banks, I think they have always had one eye, and should always have one eye, maybe two eyes now, on the Asian market. Because we've talked about the big tech providers coming, but they genuinely have arrived. It's not necessarily Ant Financial that have arrived, but Asian money has been coming into the UK for a significant amount of time in the construction businesses, in corporate finance, and now the tech's coming. So Alibaba is doing a huge amount with Alibaba Cloud, and it's only a matter of time before Alibaba Cloud starts to support the same technology that is deployed in Alibaba Cloud in China. So I think banks need to take it even more seriously about how quickly they need to start innovating, not just to protect their own businesses, but to start to look more aggressively overseas about how they can exploit the corporate and SME sector.
Yeah, and just to chime in with what Roger's saying there, so I was actually on a trade mission with the mayor 3 weeks ago, and that was to China, and we're over there on Singles Day, which I don't know if anybody's aware, but basically Singles Day, if you're a single person, you buy yourself a gift. Amazing, right? Anyway, they managed, Alibaba alone, £30.8 billion worth of sales in a single day. Was amazing. From my perspective, actually going, we went and visited Ant Financial, Baidu, WeChat, Tencent, JD.com. I have to say, just the scale and ambition of what they're doing there is incredible. It's basically, looking at what we do, it really pales into insignificance. The one thing I did take away, so they are like outright just focused in terms of AI and machine learning. And when you consider, there is a lot of issues out there, first of all, within the fintech space, especially peer-to-peer lending, which I'm sure you're fully aware of. But in terms of the AI and machine learning perspective, it's almost like this playground, 1.4 billion people, the most kind of overly securitized country in the world. And, there's so much data out there. And they're actually attracting, a lot of talent from North America, from Silicon Valley, who want to get into this playground because, you know what, they've got access to so much information and data there, and there isn't the same regulatory controls as there is in Europe, right? So I think we're going to see the next big innovation in terms of AI and machine learning come out of China. And I fully agree with your point. I found the place fascinating.
Very interesting.
I'll just build on that because we're a data company that uses technology like AI and ML, and that comes down to data. So what China has is the ability to access data. It's a cashless society for the most part now, thanks to WeChat and others. And,
QR codes, yeah.
And what the UK, what has been I think a huge leap forward in the last decade is the fact that we've moved increasingly towards a cashless society. Now you can walk down a number of the many markets here in London and pay with an iZettle, a Square, or another POS cashless device. And that's changed the game because then you have access to data, then you can do all sorts of innovative things. So I think globally, if you start looking at the other markets that are also moving to a cashless society, it adds a whole bunch of efficiencies from a tax perspective and others, but it also has gives us the ability as third-party players to really build off that data.
Just one thing to add as well to that. The other thing that I did notice with China, nobody talks in terms of the big players. They don't refer to themselves as fintechs. It's all about tech fins, and it's a very different mindset in terms. I mean, you talk about, Roger, in terms of having deep tech. There we go. But again, looking in terms of the scale and aspirations over there, I think there's a lot that our banks could also learn from them as well.
I'll mention one other thing just while we're talking about it. We're part of the FCA regulatory sandbox here in the UK, and they've been talking a lot. We are in a regulated industry, so moving market to market is not simple. You still need to think about regulation. And they're talking about a global financial regulatory sandbox. And that will be interesting because that will then connect the UK and other markets. And if you can ease the transition of using the data in different ways in different markets, I think that will be great for all of us.
Still waiting.
Still waiting, yeah.
Fantastic. I think that's probably us done. Greg, would you like to say a few words of thanks to the panelists or sort of finish the
Yeah, no, definitely. Just apologies, we have no time for questions, but thank you for listening today. Thank you to our panel, a fascinating session, very insightful. If you have any questions after the session, then feel free to drop them to myself or use some of the details on the screen, or visit the site and you get some more resources. But yeah, thanks for listening and have a great day. Thanks a lot. Bye-bye.